Hello, I'm Niels Christensen, editor with KITCO News. Welcome to the Minds of Money Online Connect Virtual Mining Conference. I'm really excited about today's conversation. Today, I'm talking with Sean Fieler, President and CEO of Equinox Partners. Sean, thank you very much for this conversation today.
Good to see you.
Now, we have 20 minutes, deep dive into the health of the economy, health in the mining sector. Where is the value in the mining sector? But first, talk a little bit about Equinox Partners. You actually do have a fairly big position in the mining sector, sort of across sectors.
No, it's our largest single weighting across our various portfolios. And we've been invested in gold and silver mining for 20 some odd years, but it's not the entirety of what we do. We are better business value investors who invest globally. And, we've really, for much of the last 20 years, found a lot of value as contrarians, being long-term investors in the gold and silver mining space, where most generalists simply aren't and haven't been.
I was going to say, it feels like the entire mining sector is just always contrarian. It's especially when we see record S&P, the S&P 500 going from record to record.
Yeah, I think it's, it's cyclical. It certainly has been over the last couple of decades. But today it's extraordinarily contrarian. And so if you look at, the S&P is up 17, 18%, and then the commodity index is up, 30%. At the same time, you have gold down single digits for the year to date, and you have, the gold mining junior index down 24% for the year to date. And so it's really fallen out of favor at a time when other commodities have actually done quite well. And so you have just a really some very deep pessimism in the sector and a lot of irrationality in the way these companies are being priced.
Well, and I guess this leads me to my first question, and you probably summed it up, but what's your take on the health of the mining sector? Nothing that you said right now, I don't disagree with, but it does feel like there is value in especially in the equities space.
So from a financial health perspective, the sector is very healthy. These companies have paid down debt. They didn't have a lot of debt to start with, but what little they've had, they've paid it off. They've held ASIC flat, so they're all-in sustaining costs flat for a decade. So in 2012, they had a bump up at the kind of a post 2007, 2008 cyclical peak hangover as they brought in some of those mines. And now for the last 7-8 years, they've been getting back to where they were pre-peak, so 2010, 2011 in terms of their all-in sustaining cost. They're returning capital. You have dividends doubling year on year in 2021 versus 2020. But at the same time, you have a lot of pessimism in the space. And so kind of the sentiment in the C-suite reminds me very much of what Don Cox used to say about great investment opportunities. It's the people that know it the best that love it the least because they've been hurt the most. And so you have these large companies budgeting on $1,200, $1,300 gold and really reflecting that in the way they're talking about their companies. And I think that's been continues to really weigh on the sector.
It's really interesting. We can spend so much time talking about, sort of the value creation and the health. I was reading a report from BMO, and they said that gold prices are on track actually this year to see their highest yearly average on record. And again, so there is plenty of value in the sector. How do we get investors to look at it? It feels like no matter how beat up this sector is, it just can't attract investor attention. Compare it to like the tech stocks. I mean, we saw the boom and bust in 2020. We saw the bust in the .com in the early 2000s. But they're just coming back to it. It feels like investors were burned in the mining sector back in 2011, 2008, 2011, sort of run up and peak and drop, and now they avoid it like the plague. And I'm just but there's value in it. How do we get investors back into this mining sector?
Well, I think the the total returns that you're going to get owning these companies, if one, certainly if you're at a cyclical peak in gold prices, which seems to be part of the market sentiment and part of the way these companies are budgeting and investing. But even if you just have flat gold prices, you can get reasonable returns. So you can get certainly a better dividend yield than you get in the S&P. You can get 2 to 4% dividend yields in some of the seniors these days, but that's a 30 to 40% return on capital, depending upon the company. And then because they're investing based on $1,200 to $1,300 gold, certainly amongst the larger companies, you're really not seeing much in the way of growth. A lot of these companies, it's kind of flat out the next 5 to 10 years. And as an aggregate, as a group, you'll see low single-digit growth rates. So if you add those low single-digit growth rates to your 3 to 4% return on capital, maybe you get a little movement in the gold price upward, maybe a little margin expansion, but you're still looking at a single-digit return. And for investors that are accustomed to doing, twice that in the stock market, it's just not that tempting unless you think either there's going to be a lot more growth in the actual ounces produced, or you're going to have much higher gold prices. And so I think that's part of the math journalists are struggling with.
Well, what do you think? Do you think we see higher gold prices? I mean, I follow this on a minute basis. We're so focused on interest rates, Federal Reserve monetary policy, whether they're going to taper, whether they're not. And this has really held gold back for this last year. And I'm sort of wondering, I mean, do you think we see higher gold prices? It feels like 2013, 2015, when they introduced the idea of tapering back, after the great financial crisis. We had the taper tantrums, gold started to fall off. And then once they did their first rate hike, that's when gold bottomed in 2015. I'm sort of wondering if that's what we need now is to get over this taper talk and interest rates and actually see that when it really comes down to it, the Fed is their hands are tied for how the neutral interest rate is going to be much lower than what it has been historically.
So two things. One is I would say, gold and silver seem to be uniquely affected by the threat of tightening vis-a-vis other commodities. So, the stock market can go up, other financial assets can go up, commodities, broadly speaking, can go up, but it's only gold and silver that can't go up on the idea that the Fed's going to taper and tighten. So I think that argument is somewhat limited in terms of the amount of water it can carry. The second point is, I think you're right, I think it's really when the Fed starts to raise rates and, puts their impotence on display for everybody to see that you really get more capital going into the monetary metals, gold and silver, because at that point, we're no longer waiting for them to start tightening, which we're bracing for, but they're proving to us, even when they do start tightening, that they're going to be behind the curve. And there's a lot of theory behind this. This is, I think, a lot of what underlies Gibson's paradox, where you have higher rates of inflation with higher nominal rates and real rates historically over long periods of time. So it's a little counterintuitive, but I think there's a lot to those historic correlations when it comes to actual increases in nominal rates and higher gold prices.
Mm-hmm. Well, and not only that, but real interest rates. I mean, when we look at, we were talking, when we were preparing for this interview, talking about inflation and the rise that we've seen in commodity prices. I mean, that has to lead to higher inflation, and that has to lead to higher real yields. But we're not paying attention to that because it's just, we're so focused on monetary policy.
So I don't think it has to lead to higher real rates. I think we're going to see higher nominal rates. Real rates might actually, I think, decline. We are so indebted as a country in the United States, but I think broadly the West, that real rates and have been and are still very much off the table, or meaningfully positive real rates in any sense that would actually impose some kind of credit contraction or force governments to pay real rates on the enormous amounts of capital and money that they've borrowed from the market. So I think that's off the table in terms of when that's going to translate into higher gold prices, higher silver prices, and higher prices for these stocks. Kind of the thesis that you started with in your question, where we're going to see higher costs, certainly the industry is on board with that. Everybody's worried about, creeping all-in sustaining cost. But at the same time, they're modeling those creeping costs without modeling higher gold prices. And so it's kind of like, the worst of all worlds, which is why you're getting now for the first time, really in my career, you have a majority of the seniors trading at a big discount to NAV. So Newmont and Agnico are the two exceptions, which trade at slight premiums to their NAV. But most of the seniors in the space now trade at meaningful discounts to NAV. And a lot of it is that pessimism around the total returns, but also kind of the dynamics that you talked about in terms of inflation pressuring margins, but not really helping you with the top line.
So, okay, so let's dive into this then. Senior producers versus junior explorers. Where's the value? Which one do you like the most?
So most of our investments, the vast majority are still in juniors. So we're seeing a lot more inefficiency, far fewer investors following the juniors than the seniors, and then the ability to analyze and really invest around the economics of a single mine or two mines in a particular geography is something that most generalists aren't really interested in. So generalists will want to start certainly investing in the space with seniors that have multiple assets across multiple jurisdictions, so they don't really feel they need to do the kind of technical analysis. So you just don't see the same extent of inefficiencies in the seniors that you see in the juniors. And in particular in the juniors, we see a lot of opportunity with finance developers that have locked in a lot of their capital cost, and they're closing that discount to their NAV through the construction process. And if they already have a lot of those costs locked in, we're going to see projects that were started countercyclically come in on time, on budget, and there's just a lot of value to add there.
So is it a little crowded though? I mean, I guess one of the things I hear about the junior space is we need to see more M&A activity. Love to get your thoughts on sort of the especially when capital is limited. Like what does the future look like for junior explorers?
Well, the idea that we need to see consolidation sounds like something that some of the seniors would say that want to buy juniors cheaply. So, Newmont's talking that. You're seeing a couple of other big companies kind of going to that talking point. Maybe they can actually consummate a couple of no premium, very low premium deals like you're seeing with Kirkland. But in general, I don't see an appetite amongst the juniors to sell, certainly at, very low premiums or no premiums, and to sell at cyclical lows. Why they want to do that doesn't make a lot of sense. I think you had some particular dynamics in the case of Kirkland where Tony's getting the job for the merged company as CEO that are attractive to the selling company. It's not clear that's attractive to all the shareholders who accepted that bid. But other than those kind of idiosyncratic dynamics, I don't see, absent really sizable premiums, a lot of consolidation in the space.
Do you think that's part of the reason why a lot of investors are sort of avoiding the space? I mean, everybody's talking about, there's supposed to be lots of merger and acquisitions, but we're not seeing a lot of big premiums. I mean, like you say, Agnico versus Kirkland. A few years ago, Barrick had that no premium bid for Newmont. It feels like investors, if they're even in the space, they don't get rewarded. I mean, is this the new trend, or how do we find valuation in this market?
So I think given the struggles that some of the seniors have had replacing reserves and what they've had to pay per ounce in their exploration budgets, I think they do need to be acquirers over time. Some of them need to be acquirers even just to maintain their production. And I think they will pay good premiums. I think what you're seeing in the market right now is I think you're seeing a bear market mentality that's not just in the C-suite in the boardrooms of a number of the seniors, but is also really clouded, I think, the investor psyche in the space. And so investors are punishing, not rewarding companies that are making even very accretive acquisitions, like what Endeavor did last year in 2000, where they made 2 acquisitions at very attractive prices in a very challenging year for the industry. You would have thought that would have led to a real re-rate in that company, and it simply didn't. They weren't rewarded for doing those deals. And so the C-suite and boards are responding to that investor pressure, which is why they've doubled dividends year on year, which is why you see those higher payout ratios. But underlying all of that is still, I think, a pessimism about the long-term prospects for gold and gold mining that permeates all their comments. And so one of the things that I just found particularly galling was now the fraction of gold mining CEOs that are talking about their copper exposure, as if though copper exposure and having a growing copper exposure is a plus, because copper, unlike gold, obviously can go up. Which is pretty rich thing to say if you're a CEO of one of these larger gold mining companies.
I completely agree with you. Like when Newmont comes out and starts talking about, their copper deposit, I just, they're the largest gold producer in the world, and they're talking about copper. It feels like we're at the pessimism. Like nobody wants to talk about gold. It's just this added pessimism in the markets.
Yeah, but that's the opportunity, right? So now you can come in, you've got a backstop you can get your 4% yield in one of these larger liquid companies. You can certainly get a higher yield than that in one of the juniors. And these are yields that are not just sustainable at $1,800 gold. These are yields that are sustainable at, $1,500 gold. And depending upon what you're finding amongst the juniors, you can really get, cash flow yields in the 30s, free cash flow yields in the 20s. These are percentiles. So I think there's a lot to do for value investors in the space. Obviously, there's a bit of a hurdle for people that haven't historically been invested in the space, is getting comfortable with the technical aspects, the geology, then getting comfortable with the geography, and then doing all of that in a COVID environment where it's not easy to get to all these mine sites and actually get up to speed on these assets. So you think you have a confluence of things that have created this moment, but nonetheless, it's a really attractive place to be.
Well, so I was going to say it does, especially senior producers, they are giving dividends, and not just like they're giving significant dividends, like financial stock, bank stock dividend styles. Yeah. and buybacks. I mean, is that if you're a new investor, is that where you go? If you're a generalist, how do you build your portfolio, especially if you're a generalist, you're new to this company, you're new to this sector. You've made your billions in Bitcoin, and now you need to diversify. How do you set up that portfolio? Is it weighted more with the producers to get the dividends, or do you want the upside with juniors?
What we tend to see is people coming in and they want the liquidity and diversification of one of the larger passive indices, so something like the GDXJ. At that point, they're not stock picking; they're picking the sector, but they're getting the broad-based undervaluation of the sector. Or you can buy, obviously, the larger companies. We actually see a number of people will come into the space and just buy the royalty companies, which, unlike all the other investment opportunities in the space, trade at a real premium to NAV. And I think their math and their return profile is a lot more challenged than the actual producers themselves. I think it takes a while before you would have the confidence on a company-specific basis or asset-specific basis to really run a concentrated portfolio where you're going to have very differentiated returns from the index. That's what we do. But there's the same people that have been doing that for a long time, but there's not a lot of new company in that space, which is part of the reason why you get a lot of the inefficiencies and pricings of these particular securities. And so you'll have companies that'll put out monster drill holes, really change the nature of their production profile, change their reserve base, change what you can estimate logically as their future free cash flow, and just not really have that discounted in the market. And so it's not like you're speculating on what's going to happen. You're able to invest around the news that's already in the public space, just because there's a relatively few investors and constrained amount of capital that's active in the space in any kind of concentrated way.
One of the things that we sort of talked about value, I just wanted to ask, where's the pain point for the mining sector? Is it 1,500? Is that where we start to see sort of the sector fall down?
So I think certainly the stocks are going to decline if you go to 1,500 from $1,800 gold. The seniors are budgeting on the 12 to 1,300 on the idea that they're going to be in business at those prices. A lot of the juniors don't have the luxury to do that, but it's very uneven even amongst the juniors. Some of the juniors have much lower ASIC than some of the seniors just because they have one spectacular asset. Whereas the juniors, unlike the seniors, some of those will go put in production what are today considered more marginal assets, in that they have all-in sustaining costs that are meaningfully north of 1,000. So I guess it kind of really depends in terms of what spot you're picking, what spot you're picking across the spectrum of developers versus seniors versus market caps, et cetera.
Just a couple more questions here. This has been a really interesting conversation, Sean. I thank you very much for your time. What criteria do you guys look at Equinox Partners? When you're looking at a possible investment, just sort of want to give, especially I guess for people who are more experienced, what should they be paying attention to? So
one of the biggest points of emphasis for us has been governance and in alignment with insiders. And so you've had in the industry broadly, but certainly amongst the larger companies, you've had a lot of board turnover in recent years, and you really have a dearth of, especially the non-executive directors that have bought any stock with their own money. They have DSUs or RSUs. These are shares given to them by the companies as part of their compensation. Often their aggregate ownership, even through that, is relatively modest in comparison to their annual compensation. And so they just don't have the same motivation and alignment as long-term shareholders in the space. And so solving for a lot of those agency issues has been, I think, is essential in the space. It's what we spent a lot of time on. In the seniors, it's really generally insoluble. Amongst the juniors, you can find companies where you're very well aligned with insiders, and where you really see that same long-term thinking in terms of the way the directors and the C-suite are buying and owning shares as you are, and that's really how they're intending to profit from the exploitation of the various assets that they buy and control, instead of just paying themselves some annual retainer and compensation and have that path to trying to compensate themselves. So that's been for us a big focus.
That's really interesting, because this has actually been an issue. I remember reading a report from the Gold Shareholder Council, this group created by fund manager John Paulson, and he was saying that the compensation is out of line, and the more compensation is in line, the better the company does for all shareholders. Interesting. Then, do you think this could be? No, I guess not a silver bullet. There's not one silver bullet, but should executives be taking a bigger stake, showing that confidence in their company, in their projects?
Yeah, 100%. So, Endeavor is the best case, where you have two directors that really have very substantial equity investments in the business. And then you see the countercyclical behavior, you see the long-term value creation at Endeavor Mining that you don't see at a lot of the other companies of size in the space. It's a real concern. One of the solutions to it was what Paulson actually did a couple of years ago with Detour, changing the board, but you really don't have activists in the space. And so that hasn't become a trend. That was more of a one-off. And so if you don't have real alignment of interest with insiders, and there's not a activist dynamic in that particular company, that can be a very difficult gap to bridge in terms of getting those interests aligned.
Like I say, Sean, this has been a fantastic conversation. I thank you very much for your time. Our time has run out, but stay tuned for more great content from Minds and Money. Thank you very much.
No, thank you so much.